Hey everyone, welcome back to the Velocity channel here. Listen, we are going to be sharing with you something new. And shout out to Credit Plug. We're going to make sure that you know how to get $1,700 without working for it. All right. We want you to have the funding that you need in order to pay off your obligations, as well as make sure that money is going towards the places where Velocity Banking does best. But before we do that, I want you to make sure you like, share, and subscribe so that everyone around the world can know how powerful Velocity Banking is. Are you ready? All right, let's go. All right, so number one, you download MoneyLion, right? And then you tap Instacash. Number two, link a qualifying checking account to access 0% APR cash advances, no credit check. So everyone that's like, man, cash advances cost money, not in this situation. All right. Number three, select the amount you want. The standard delivery is going to take about 5 business days to get your money. If you want to get it within minutes, that's a variable fee with it. All right. So any income or recurring deposits, including government benefits, that helps you qualify. Now, a little word on that. The higher and more consistent the deposits, the higher the Instacash for you. So I definitely need to make sure that you know about that. So if you sign up for the Credit Builder Plus program, which is only $19.99 a month, you can unlock up to $700. All right, that's where we're getting our $1,700 from. Watch this. And now you want to combine that with linking your Roar Money account direct deposit, and then you can unlock up to $1,000. So $1,000 plus $700. That's where we got our $1,700 from. Okay, so nice and simple, right? You can click the link below to go ahead and get started. But anyway, we're going to get started in making sure that you know how to pay off what you need to. So here we have different loans. Okay, this could be a loan one. It doesn't matter what loan it is. Okay, mortgage. It can be a car loan. It can be any loan. Okay, loan 3. Okay, make sure that you realize this, that you never want to be in a position where you're negatively cash flowing, or that you are having that time and balance and interest work against you. When you break this down the right way, you'll find yourself making sure that your cash flow is always there in your lines of credit and in your checking account, so that you can pay off any loan that you need to very, very quickly. Why? Because you're going to be paying not only the monthly amount, but also the principal, but in a more systematic way. Okay. Now, if you were already on or already own the Money Max account, you know that you don't even have to think about this. You don't even have to calculate it. Okay. And that's very good for you. But for those of us who, right? Well, not us, because I have the Money Max account, but for those of you who are still doing the calculating thing, that's fine. This is how you do it. Okay. With the $1,700, we don't want to just divide it into 3. Let's say you have 3 loans. You don't want to do that. What you want to do is you want to figure out which loan, right, is the most cash flow sucking, and then aim at that one. Okay. We want to make sure that loan is getting aimed down. We want to use the banking algorithm against the banks and for us. Those that know about interest earn it. Those that don't know about interest pay it. We want to be the ones that are earning it. Okay, so this is how you figure that out. You make sure that you take your loan balances. Let's say it's all 3 of them. It doesn't matter if it's all 5 of them. It doesn't matter if it's all 7 of them. We want to make sure that we're taking that balance, okay, loan balance, and we are dividing it by the minimum monthly payment. Now, let's go ahead and abbreviate that with an MM, where we abbreviated the loan balance with LB and abbreviated the minimum payment with MM for minimum monthly. Now, this is the thing. We want to make sure that we are not bleeding cash flow each and every month. So this is how we do it, okay? We're getting rid of these loans. So let's say we already have our cash flow index number by dividing the loan balance with the minimum monthly payment. And we get a number that's between 0 and 50. Okay, if you get a number that's between 0 and 50, what that means is that you've got a danger zone loan. Let me say that again. 0 to 50 is a danger zone loan, and you want to make sure that you're paying those loans off very quickly, because those have been identified as inefficient loans, meaning they are sucking your cash flow relative to what you're getting in the balance. That means you are paying too much monthly relative to what you're getting in the balance. Okay? This is why many times we find that mortgages are on the freedom zone of the scale. Meaning, hey, you don't ever have to pay that back, even though you're going to, right? But that's going to be last on the list because we found out that people are paying about what, $1,200 per month, right? But the loan is $200,000 per, $200,000 loan. And so that's not a cash flow sucker. What would be a cash flow sucker is you're only getting $10,000 and you're paying $1,200 a month for that $10,000. Do you see what I'm saying? So the higher the loan balance and the lower the minimum monthly payment, this is the thing, you will have a freedom score of 100 and above. So that's where we're at there. But you want to make sure these loans, however many they are on this scale. And then you simply want to pay them off accordingly. Okay? Very simple. So you're going to take the loan that is between 0 to 50, and then you're going to take the loans that are between 51 to 99. Okay? And you're going to say, man, which ones am I going to pay off first? Okay, first of all, 0 to 50. Why? Because they're in the danger zone. Well, with the loans that are 51 to 99, those are in the restructuring, right? Those can be restructured. That's the caution zone. So let's go ahead and say that you have a car loan that actually comes in between this. Did you know that you could actually negotiate? What about the credit cards that come between 51 to 99? You can say, you know what, man, I've been pretty good. We're paying my card down. We're paying our line of credit down. We're paying this loan down. Is there any way we could restructure this? Because I need this to be on a higher scale. I don't need it to be at 51 anymore. I need it to be at a 60 or a 70, right? I need more cash flow relative to my balance. Huh? Come on, somebody. And so that's where we're at there. Now, let's go ahead and look at this. We have $1,700 that we're not just going to divide up and then place towards these loans. But this is a one-time payment of $1,700, right? So we want to make sure that we are using this in the most efficient manner. This is how we use it, okay? You're going to put that $1,700 to that loan that is the cash flow sucker. Why? Why? Because you're knocking down the principal. And as you're knocking down the principal, what else are you knocking down? You're knocking down the interest. But CJ, I have a scheduled payment. It doesn't matter. If you have a scheduled payment, what does that mean? You're jumping years ahead to paying it off. Okay, so we want to make sure that we're using that $1,700 very wisely. And when that income comes in, because what if the bank is like, man, you can't get paid today because there was a problem with our systems? Look, you got the $1,700 so that when the systems are back up, you can just continue as usual. All right, listen, folks, please click that link below. Get that $1,700 for you. All right, and we will see you in the next video. God bless and have a good night.